Ever wondered how you can make money while you sleep or while you're on vacation? Is passive income just a dream, or can it be your reality? Well, let's dive into this fascinating world of financial freedom, where your money works for you rather than the other way around. Picture this: a life where your income doesn't stop when you clock out, where your bank balance grows even as you catch some Z's or while you're sipping margaritas on the beach. Sounds too good to be true? Not really if you understand the concept of passive income. This is income that requires little to no effort to earn and maintain. It could come from rental income, business partnerships, stock dividends, and yes, even treasury bonds. One such form of passive income often overlooked is investing in treasury bonds. Want to know how it works? Stay tuned. Before we dive into the how, let's understand the what. So, what exactly are treasury bonds? These are essentially a loan you give to the government. Yes, you heard that right. When you purchase a treasury bond, you're lending money to the government. In return, the government promises to pay you back with interest. The interest is fixed, meaning it won't change over the life of the bond. Treasury bonds are considered to be one of the safest investments you can make. Why? Because they are backed by the full faith and credit of the U.S. government. This means that the government guarantees you'll get your money back, plus interest. So not only do you earn from your investment, but you also have a high level of security. Now that we know what treasury bonds are, how do we go about investing in them? Investing in treasury bonds may seem complex, but it's actually quite straightforward. Here's a step-by-step guide. First off, you need to identify your investment goals. What do you hope to achieve with your investment? Are you looking for a steady stream of income, or are you more interested in long-term capital growth? It's crucial to have a clear understanding of your financial objectives before you dive in. Next, you need to choose the right type of bonds. Treasury bonds come in different types, each with its own set of characteristics. There are treasury bills, which are short-term securities with maturities of 1 year or less. There are treasury notes, which are intermediate-term securities with maturities between 2 to 10 years. And then there are treasury bonds, which are long-term securities with maturities of 10 years or more. Each type has its own risk and return profile, and your choice should align with your investment goals. Once you've chosen the right type of bond, it's time to make a purchase. You can buy treasury bonds either through a broker or online directly from the U.S. Department of the Treasury's website. It's a simple process. All you need to do is follow the prompts. Select the type of bond you want to buy and enter the amount you wish to invest. Finally, you need to monitor your investment. Even though treasury bonds are considered a low-risk investment, it's still important to keep an eye on their performance. Check your bonds regularly, make sure they're meeting your investment goals, and adjust your strategy if necessary. And there you have it, a simple guide to investing in treasury bonds. But why should you consider this as a form of passive income? All right, so you've got the basics down. You know how to invest in treasury bonds and why they can be a great source of passive income. But how can you maximize your returns? The answer is through a strategy known as bond laddering and the magic of compounding interest. A bond ladder is a strategy of buying a series of bonds with different maturity dates. Imagine a ladder with each rung representing a bond that matures at a different time. This way, you'll have bonds maturing and providing income at regular intervals. This strategy not only gives you a steady stream of income, but also reduces the risk of being locked into a low interest rate for a long period. Now let's talk about compounding interest. This is essentially the process of earning interest on your interest. Each time a bond matures, you can reinvest the principal and the interest earned into another bond. Over time, this can significantly increase your returns. So by using a bond ladder and taking advantage of compounding interest, you can make your money work even harder for you. It's like giving your passive income a passive income of its own. With this strategy, your treasury bond investment could provide a steady and reliable income stream that grows over time. Remember, the goal here is not to get rich quick, but to build a solid financial foundation and achieve long-term financial stability. Now that we've learned about bond laddering and compounding interest, let's address a crucial question. How much of your portfolio should be in treasury bonds? Well, this is where asset allocation and diversification come into play. Asset allocation is about spreading your investments across different asset classes, to balance risk and reward according to your investment goals and risk tolerance. Diversification, on the other hand, is about spreading your investments within each asset class. So, if you're investing in bonds, you might want to diversify by investing in bonds with different maturities, issuers, and interest rates. Now, how much you should allocate to Treasury bonds depends on several factors, such as your age, risk tolerance, and investment goals. As a rule of thumb, the older you are, the more you might want to invest in bonds because they're a safer investment. So if you're 30, you might want to have 30% of your portfolio in bonds, and if you're 50, you might want to have 50%. But remember, these are just guidelines. There's no one-size-fits-all approach to investing. Your bond allocation should reflect your individual goals and risk tolerance. So take the time to understand your financial situation and make informed decisions. Remember, the goal here is to build a solid financial foundation and achieve long-term financial stability, not to chase after quick gains. Did you know that Treasury bonds have some unique tax advantages? Yes, they do. Let's explore this further. When it comes to taxation, the interest earned on Treasury bonds is exempt from state and local income taxes. This means that you'll only have to pay federal income tax on the interest you earn, which can be a significant advantage if you live in a state with high income tax rates. Furthermore, Treasury bonds can be a useful tool for tax planning. Since they have predictable interest payments and maturity dates, you can plan your tax liabilities more efficiently. However, it's important to note that while Treasury bonds offer certain tax advantages, they may not be suitable for everyone. For instance, if you're in a high federal tax bracket, the after-tax return on Treasury bonds might be lower than what you could get from other investments. Therefore, it's crucial to consider the tax implications when deciding how much to invest in Treasury bonds. With Treasury bonds, you can not only earn passive income, but also optimize your tax situation. But remember, always consult with a tax advisor or a financial planner to understand the full implications based on your personal financial situation. Stay tuned as we summarize the key points in the next section. Diversification is key in investing. It's like not putting all your eggs in one basket, right? So where do Treasury bonds fit into this diversified portfolio? Let's find out. Diversification helps reduce risk in your portfolio by spreading your investments across different asset classes. It's like a safety net for your investments. If one asset class underperforms, others may perform well, balancing out the overall risk. Now, Treasury bonds can be a solid addition to your diversified portfolio. Why? Because they come with a low risk and a guaranteed return. They can complement riskier income assets like stocks or real estate, providing a more stable income stream. So even if your other investments are on a roller coaster ride, your Treasury bonds can provide steady income. When constructing a diversified bond portfolio, consider factors like your risk tolerance, investment goals, and time horizon. You may want to include a mix of short-term, intermediate-term, and long-term bonds. Also, consider varying the credit quality of your bonds. By diversifying your portfolio, you can balance risk and return and make your money work in different ways. Remember, it's always about balance. In the next section, we'll summarize the key points about Treasury bonds and how they can contribute to your financial success. Stay tuned. Treasury bonds might not be the first thing that comes to mind when thinking about passive income, but here's why they should be on your radar. Now, we all love the idea of money working for us, right? Well, Treasury bonds do just that, offering a steady stream of income over time. They're also one of the safest investments you can make. Backed by the full faith and credit of the U.S. government, Treasury bonds are as good as gold when it comes to security. So, you can sleep soundly knowing your money is safe. And the best part, you don't need to be a Wall Street whiz to get started. With a low investment threshold, Treasury bonds are accessible to just about anyone. So even if you're new to the world of investing, Treasury bonds can be a great place to start. Treasury bonds are a safe and reliable form of passive income. They may not make you a millionaire overnight, but they will surely help you build a solid financial foundation. Investing in Treasury bonds can be an effective way to generate passive income and secure your financial future. Remember, understanding the ins and outs of these bonds is key. Never stop learning. Financial literacy is not just about making money, it's about protecting and growing it too, so Keep on exploring, keep on questioning. If you found this video helpful and want to learn more about building wealth, don't forget to hit the subscribe button. Keep investing, keep learning, and let your money work for you.